SoFi just reported their latest quarterly figures. Stock is basically flat at the time of making this video, but the quarter beat across the board, guidance as well. But I was wrong yet again with my predictions. Some good, some misses here and there. Now let's go over all of those figures. First, let me show you my predictions. So I was expecting Q2 new members to come in, to increase 620,000 with a CAC of $265. Galileo, or should I say tech platform, Q2 revenue above $100 million, Q2 net revenue $585 million, adjusted EBITDA $140 million, and deposits over $3 billion. Now from my predictions, these are the big misses in my eyes. So Galileo, Q2 revenue came in at just $95.4 million, and deposits, first of all, they don't even tell us the deposit, they just tell us the overall number, but then you just have to look at the Q1 numbers and you can figure it out. It was a 1.4 billion increase. I mean, that's a question. Maybe they'll answer that in the earnings call. But Q2 new members came in higher than expected, 643,000, but a CAC did increase to $287, increase in spending, sales and marketing. Q2 net revenue came in also above my expectations, $597 million, but adjusted EBITDA a bit lower than my expectations. A tiny bit, was at 140, came in at 138, but Q3 figures looked quite good. So let's go over the whole thing. Before doing so, if you enjoy this type of content, leave a like, subscribe, notification bell on, do all of that. Next video will be the PayPal earnings report, so stay tuned for that. And if you want to support me even further, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So let's first start with a couple of comments from Anthony Noto, the CAO. We had an exceptional second quarter. Our relentless focus on product innovation and member growth across our portfolio of business not only drove strong results today, but we expect that they'll fuel financial growth for years to come. Our one-stop shop strategy continues to deliver strong, diversified growth and profitability despite macroeconomic volatility. Our financial services and tech platform segment now make up a record 45% of SoFi's adjusted net revenue, up 38% year over year and 32% over 2 years. In the second quarter, these businesses grew revenue by a combined 46% year over year, given our clear structural advantages and leading value proposition in financial services, along with the tech platform's continued progress on its journey of becoming the AWS of financial services. To be honest, I don't really like the fact that they're using like the AWS of this or that. But okay, let's continue. Despite the rate of environment and our conservative stance in lending, we drove sustained strong results in the quarter and are ready to move quickly once things improve. Net interest income was $412.6 million for the second quarter. That's up 42% year over year and 2% quarter over quarter, with net interest margin of 5.83%. That was up from 5.74% in the prior year quarter. As for SoFi Bank, that generated $98 million of GAAP net income at a 20% margin in the quarter and an annualized return on tangible equity of 11.2%. Now, as for the tech platform, a bit of a disappointment to be honest, because I really thought that we would be above $100 million in revenue, but okay. Tech platform, net revenue $95.4 million, that's an increase of just 9% year over year. Contribution profit of $31.2 million, increased 82% year over year for a margin of 33%. So that's great. They're also continued saying the same thing over and over again. Our pipeline of interest remains robust and includes US and international financial institutions. This time it changed a little bit. Usually it's US and LATAM. Now it's international financial institutions, along with major consumer and commercial brands. We continue to pursue enterprise partnerships with larger existing customer bases for more durable revenue opportunities. These partnerships take multiple quarters, not months, to win and have longer integration cycles due to their size and complexity. We've talked about that in the Galileo video, which we'll be able to find in the top right corner. So far, so good, right? Maybe our expectations were a bit higher, but so far, another flawless quarter, flawless execution by this management team. So, members, that increased 41% year over year, now reaching 8.8 million members. That's great. Products also increased quite nicely, 36% growth year over year. New products added 946,000 in the quarter. As for Galileo accounts, that continues to grow very nicely now. Well, previously it didn't grow that fast, but now second quarter in a row above 20% growth year over year. Of course, Q2 was quite weak-ish, let's say, so the year-over-year comparisons here look better, I would say, but let's see if we can continue that trend, because afterwards Q3, Q4 2023, those were a bit better quarters. So let's try and continue that trend, but overall Galileo exceeded here my expectations. As for the quarterly performance, so quarterly adjusted net revenue came in at $597 million, growing 22% year-over-year growth. So yes, revenue growth is decelerating. This is probably something that the stock market doesn't like to see. You will also look at the Q3 numbers. It might decelerate a bit more. Quarterly adjusted EBITDA, now 3 quarters of being a bit lower, but of course there were some one-time things happening there. Still, EBITDA margin of 23%, but this part is expected to become better in the next quarter already. As you can see right here, adjusted net revenue to grow between 18 to 22% year over year. So maybe we're going to see a bit of the same, maybe even more, since they always beat their own expectations, but okay, acceptable numbers. Adjusted EBITDA with an adjusted EBITDA margin of 26%, so adjusted EBITDA coming at $160 to $165 million, which of course is a big improvement from Q2 and Q1. They also expect GAAP net income between $40 to $45 million, and so diluted earnings per share of 4 cents. This quarter was closer to 1 cent. And now looking at guidance. So for the third quarter, we've just seen that, but for the full year, management now expects to deliver adjusted net revenue of $2.42 to $2.46 billion, which is $35 million higher than the prior guidance range. This implies 17 to 19% annual growth versus 15 to 17% previously. This guidance now assumes lending revenue will be at least, this is very, very good to hear, at least 95% of 2023 levels versus prior guidance of segment revenue of 92 to 95%. So it could very well be that lending stays flat year over year and does not actually decrease. They also expect the financial services segment revenue to grow more than 80%. Again, more than 80% versus prior guidance of more than 75% growth, and for tech platform revenue to grow mid to high teens percentage year over year versus prior guidance of 20% growth. Management now expect to deliver adjusted EBITDA of $605 to $615 million, above prior guidance of $590 to $600 million. This represents a 25% adjusted EBITDA margin. Now also expect full-year GAAP net income of $175 to $185 million, above prior guidance of $165 to $175 million, basically adding $10 million to the top and bottom line, and GAAP EPS of 9 to 10 cents, above prior guidance of 8 to 9 cents. So again, very, very well received in my opinion, even though the market currently says, okay, cool, but the stock stays flat. Like I said, broken stock, definitely not a broken company. And so looking at the stock right now, literally nothing has changed from yesterday, basically flat. So for the week, we still have a red candle, which sits very, very close to the 200-day moving average. RSI is very neutral. Maybe when the market opens, maybe after the earnings call, the stock will make some moves. But right now, in my opinion, purely looking at just the report without the earnings call commentary, I would have expected the stock to move up, but then again, it's SoFi stock, it's a bad stock and a good company, so I'm not that surprised. If the stock doesn't move or it goes down, my plan is pretty simple. I'll probably buy extra shares. I might let the market digest the numbers a little bit more and then make a move, because to me, again, a good quarter, bad stock, perfect opportunity for long-term investors, unless of course something gets mentioned during the earnings call that changes my mind completely. But I highly doubt that's the case. So overall, that's about it for this video. Don't forget, next one is PayPal. Good quarter as well, so stay tuned for that. Like, subscribe, do all of that, and I see you all in the next one. Bye-bye.